You know, the construction industry is fascinating. It literally builds the world we live in, our homes, our hospitals, you name it. But for investors, it's a really tough place to be. We're talking huge projects with razor-thin profits. So that brings up a huge question. Can a company in a business that goes up and down like this actually create real long-term value for its shareholders? Let's dig in.
On the surface, the business model seems almost childishly simple, right? You win a contract, you build the thing, and you get paid. But that simplicity is so deceptive. Can that straightforward process really deliver the kind of steady returns that long-term investors are looking for?
To figure that out, we're going to follow along with an analyst's really deep dive into one of the big players up in Canada, Bird Construction. We're going to look at their logic, we're going to crunch their numbers, and see exactly how they landed on their final verdict.
Okay, so before we can really understand Bird, we have to get a feel for the world they live in. And the construction business is the perfect example of something that is simple but not easy. There are some major risks just baked right into the system.
I mean, this quote from the analysis just says it all, doesn't it? It's a high-stakes game. One bad bet, one project where the costs get out of control, and poof, all the hard work and profits from countless other successful jobs can just vanish.
So this is the constant tug of war for a company like Bird. On one side, you've got a ton of demand. Governments are spending on infrastructure, things need to be built, so that creates a nice, healthy backlog of work. But on the other side, the profit margins are always going to be thin, and the risk that a project goes completely off the rails is always hanging over your head. It's a real balancing act.
So how does a company not just survive, but actually thrive in an environment that's this challenging? Well, the key is having some kind of competitive advantage, what investors like to call a moat, that protects you from the competition. And just for a quick refresher, a moat is basically any durable advantage that keeps your rivals away, kind of like a real moat protecting a castle, right? It could be a super strong brand, some unique tech, anything that gives you an edge. The big question is, does Bird Construction actually have one?
Well, the analyst's answer is kinda. Bird's moat is what they call narrow. It's not based on some secret sauce or the ability to charge whatever they want. It's built on something much softer, a great reputation and solid relationships. And while they're a big company, they're not so big they can just muscle out giants like PCL or Aecon. So the takeaway is, their advantage is stable, but it's not really growing.
All right, now that we kind of get the business and where it fits in the competitive world, let's get to the fun part. Let's crunch some numbers and see what the financial story tells us about the stock's valuation. The analyst here uses a really handy metric called the PEG ratio. Think of it as the classic PE ratio, but on steroids. It doesn't just look at price versus earnings, it also pulls in the company's growth rate and its dividend, which gives you a much fuller picture of the valuation.
Now this is where it gets pretty compelling. You look at these numbers individually and they're interesting. A price-to-earnings ratio around 16, that's pretty reasonable. But when you combine that with a 5-year growth rate of almost 20% and a dividend yield over 2.5%, a much more attractive story starts to take shape. And when you run all those numbers through the PEG formula, this is the number you get, 0.67. So what in the world does that actually mean?
So as a rule of thumb, a PEG ratio under 1 suggests that the market might not be fully appreciating the company's growth. And 0.67 looks fantastic on paper. But, and this is a huge but, the analyst warns that in a cyclical, tough industry like construction, you have to take this number with a huge grain of salt. The real danger is always in the execution.
Okay, so we've looked at the business model, we've sized up the moat, and we've checked out the valuation, which is attractive but risky. So let's bring it all home. What's the final verdict? What is the bottom line here?
After mixing together a few different valuation methods, the analyst calculates what they believe is the intrinsic value, or the true fair price of the company. And that number is $30.50 per share. This number is our anchor for the rest of the decision.
But of course, the future is never a sure thing. So the analysts also looked at a range of possibilities. In a pessimistic bear case scenario, the value could drop to around $22. But in an optimistic bull case where everything goes right, it could jump to 38. That 30-50 is our most likely middle-of-the-road outcome.
Now here's where the rubber really meets the road. This isn't just an academic exercise to find a fair price. It's about meeting a specific investment goal. In this case, the analyst wants to earn an average of 9% a year. So the question becomes, what's the absolute highest price you can pay today and still have a shot at hitting that goal?
And this table just lays it all out so clearly. It's beautiful. If you're happy with a 7% return, you can pay up to $29 a share. If you want 8%, you've got to get it at 27 or less. And for that magic 9% target, the buy price has to be 25 bucks. This is where you let the math, not your emotions, make the decision.
At the time this analysis was done, the stock was trading at $29.64. So you see the problem, right? At that price, the math just doesn't work to get to a 9% return. The stock is fairly priced, sure, but it's not cheap enough to hit that specific goal.
And that brings us to this really clear three-step summary of the whole thing. 1, Bird is a perfectly decent company, but it's in a really tough industry. 2, the stock is currently trading pretty close to what it's actually worth. And 3, if you want to hit your return target, you have to be patient and wait for a better price.
So the final recommendation couldn't be simpler or more direct. At its current price, it's a hold. The time to pull the trigger is if and only if the stock price falls below $25. You don't chase the stock. You let the opportunity come to you.
Which brings us all the way back to the question we started with. Are companies in these tough, cyclical businesses nothing more than value traps, just waiting to lure you in and disappoint you? Or are they genuine opportunities for an investor who knows what they're doing and has discipline?
And the final takeaway from this entire deep dive is, I think, really powerful. A good business can be a fantastic investment, but only if you buy it at the right price. For a company like Bird Construction, the difference between a trap and a treasure isn't about the company itself. It's about the price you pay.